I'm Art Kleiner, the editor-in-chief of Strategy and Business. With me, of course, is Mark Anderson, whose writings about the economy, among many other things, I've been following for quite a bit of time, and I know I'm not the only one in the room. And in this half hour, we're going to talk about the economy as it is and as it will be. Every day it feels like we're on the threshold of some new normal, but exactly what that normal is seems to be different from one day to the next. So we're going to try to look a little bit beneath the froth and see what the trends are for the next, I guess, 3 to 5 years, right? Mm-hmm. And I'd like to start with a question that, thank you. Yesterday we talked about two great technology rollouts, cloud computing and non-carbon energy. And so I thought that might be a good place to start. If both of these go to scale, what kinds of economic effects might we see, and what other roles does technology play in the economy?
I think if we looked back about 30 years, you can easily make the argument that technology drives the global economy. We're seeing a time now where there are a few other drivers emerging, and they are non-technical. One is the conversion of abject poor to consumers, and that's more important than birth rate. So a lot of people talk about the next 3 billion or the next 2 billion. I don't think that's nearly as important as the next 1 billion consumers, and they're coming online really fast. It's easier to make a consumer, it turns out, than to make a 15-year-old. So even in the time frame we're talking about, there will be large numbers of new consumers coming online who will add to the economy and help it grow.
And which kinds of people are you thinking of?
Indian, Chinese, mostly Asian. Some South American, but the real birth rates are over there. So, or consumption rates are going to be over there. So does technology have an effect? Yes, technology still is the driver in a lot of ways. And surprisingly, I guess, even very poor people have cell phones and are adopting technology. So the cloud will be serving those people too. The economy, however, when you talk about the new, whatever that's going to be, we all, I think, are emotionally prepared for the intellectual idea that the economy is not going to be what it was. And I've seen several people say it brutally clearly. I think what we're going through right now is a return not to what we thought was normal, but a return to reality. And by reality, I mean there is a kind of a, not just a transfer of wealth, but a war between systems, between mercantilist approach to how to make money and the free market, or whatever you want to call it, approach that we think we espouse. And I think if you were honest about it, the points are all in favor of the mercantilist side. So as we lose manufacturing and as we lose IP, as we find that the ROI on IP starts to decline, how does technology do in that environment? And it's tough to make a $2 billion investment in a chip fab or in whatever you're going to do if it shows up on the street for $1, 10 days later in Hong Kong. So there's a big problem that hasn't been fixed, and I'm not sure how it gets fixed. I think we can come back to that if you want. So, fairly long answer, but we're not going to return to where we were, and in fact, we've actually seen the U.S. economy and maybe other economies split in half, cleanly split, which is not like any time before. It's not like the Depression of 20. It's not like anything that I know of. It's not like '87. So you're going to have people who are wealthy beyond their wildest dreams, who are in global commerce of some kind or other, probably with most of the revenues being technical and coming from offshore. At the same time, we're going to have a lot of people who are out of jobs forever. They lost that job, whatever it was, that they dreamed of at the age of 35, and they're done. They're not going to get back. And we have kids in this room who are looking for jobs, who are just out of school, and the job market is so oversaturated right now. It's going to be 10 or 15 years before that gets fixed, I think. So these things are big problems for the haves of the economy in the United States, and probably in Western Europe too. That's an issue that doesn't get easily fixed, and it gets clouded by averages. All we see in the press are averages. So it's like, what's the GDP? What's the unemployment rate? The unemployment rate is probably 40% in this sector. You know, that's horrible, and it's probably 0 over here.
Right.
Yeah.
When you said, you know, as we lose manufacturing and we lose IP, who's we then? It's that second economy, the former.
Someone was asking me at breakfast about how will this all roll forward, and I think the only way that if you were just a systems designer, Ty Carls, if your only job was to be very rational about the whole planet, you get a couple of choices here. Choice A, keep going as was, right? And in that case, the disappearance of your IP value will do what I just said. And the whole world essentially will stop investing in IP because they can't. Mm-hmm. It's nothing magic about it, you just can't. There's no return, or a limited return, or a lower return. So you can call it a tax if you want to instead. Or you start protecting it, and in your trade agreements, and in your policies, and in your alliances, and in your kitchen morning talk to the family, it's got to be cultural almost, where you say, you know what, civilization is based on IP. All the things we're most proud of, all the discoveries, and all curing diseases, and developing great drugs, and chips, and all this stuff is called IP. So we want to make that a keystone of our alliance structure in the world. And if I come to you, you come to me and you say, I want to trade with you, what's your IP approach? And I say, my IP approach is, I steal from everybody I meet. You'll say, thanks for your time, but I'm busy with Joe over here. And it's not hard to imagine, instead of geographical alliances for trade, which we've done already, forget that, having non-geographical IP-based alliances for trade would make a lot more sense to me. And you know, India saw this coming and had a very loose environment for a long time, and they got it, and they passed probably the strictest IP laws around, understanding, I think, that would protect them in the long run as future members of just such a trade alliance.
When you talk about the mercantilists on the other side, are you just talking about China, or are you talking about others as well?
Japan was the original expert at this, even pre-World War II. But post-World War II, much more refined. So the Japanese model is a particular model. The South Koreans took that and then, I think, improved it a little bit, depending on how you define. And the Chinese, of course, had the benefit of watching both of those before they came into their model. So we have 3 different models, all of which share some values, and the Chinese is probably much more advanced than the other 2.
Partly because of their scale, I imagine, and then just partly because of their...
Well, not always. The scale always helps, right? But the Chinese understood the importance of... They wanted to go fast. They didn't want to wait 40 years. So while Japan and South Korea, I think, are also guilty of obtaining IP in nefarious ways, China made it a government program, a serious program, in my humble opinion. And it was required of contracts of American companies and so forth that they give away IP as part of the right to trade with us, you know, with them. And at the same time, they allowed huge amounts of investment, even though they prevented outright ownership. So clever, you know. So we want your money, we want your IP, we know you want to have access to this market, and what we're going to do is we're going to take all those things that we want, and you're going to think you're going to have access, but it's faux access.
Right.
We'll give you access to cars until we make them, and then we're going to shut that off. We'll give you access for airplanes until we make them, then we're going to turn that off. And a lot of guys got fooled, I think. People got fooled in this and thought that it was either an open market or that it was partially open. And in fact, it was just a very well-done program.
So before we leave the whole IP and manufacturing question, given that this is now becoming evident in a lot of circles, and given, you know, the mention by Jeffrey Immelt and Obama and many people about revitalizing manufacturing and the similar interest in Europe, why wouldn't something like India's approach become a model then? Is it that it's too late, or is it?
No, I think it could be a model.
What would happen?
India ends up looking better and better to people who've been burned a few times. So India is a healthy competitor. They're very smart. There are a lot of in IIT graduates who are brilliant programmers and so on. They very much want to have their own industries. They are starting to, and I think India is going to have a really important place in the tech global competing community. They're going to be a real player.
And would somebody like the United States or some of the European countries follow suit, or why wouldn't that happen? Why do you say 10 to 15 years to catch up?
If I understand what you're asking, it seems to me that we have two issues here. One is cost of offshoring, and that's kind of backfiring now. We have people bringing jobs back, not for patriotic reasons, but because they found out that either they needed that expertise in-house, or they weren't able to rely for some reason on that thing. So that part of the machine didn't work very well. So what you offshore is becoming a bigger question, not just to offshore. But the U.S. has lost its manufacturing base going all the way back to cars. I mean, cars is a pretty good example. And there's some great books written about this. Jaws of the Dragon is a good one I would recommend. But you can see in a mercantilist, which by the way is a very intelligent model. In that model, you sit around with the people who are able to be most effective. They're usually business leaders and government leaders, and you have a definite trade policy. You list the industries you're most interested in targeting, and you go through those one by one, and you get them. The challenge is not to look like you're doing that or to show the money afterwards.
Right.
But that's been a very effective Japanese approach, and then South Korean approach. My test for this, except for China, is how many cars did we sell in that country? And if you go around just asking that one question, wow, I think the answer was 4 cars in South Korea and 18 in Japan. It's just not very big numbers. So it's a pretty crazy situation, and it's not just cars, of course, but that is a very easy way to see what's going on. So cars are good because they use steel and they involve a lot of employees. In Toyota's case, as an example, we all probably like Toyota. They avoided our retribution. They were really the next in line. Cars were the next in line when the U.S. woke up originally to what was happening in this model war. And Intel was on the block. They were about to disappear. They filed a complaint, and we used what was then called the Super 301 tariff law to threaten the Japanese. Well, that took 15 minutes to figure out. So they thought, well, what if we put the plants in America? Then they're American plants, right? So Toyota immediately put all their plants in America. It wasn't because they love America. It's because they didn't want to have Super 301 brought against them. And that worked fine. So now if you look at where are the manufacturing jobs, they went to Japan basically, which then offshored to China or Vietnam or somewhere else. Same with South Korea. We do have one DRAM company, but essentially all the DRAM went away.
So from arbitrage of jobs, let's talk about arbitrage of currency, where 3 days after the Greece bailout, the euro is falling a little bit. The influence of currencies and investment in them, and how does that affect what's going forward? Carry trade.
When you watch I call them the jackals. When you watch the jackals take down Bear Stearns, or any bank, big banks. Bear Stearns lost $33 billion in value in 2 days, over a weekend, mind you. No one was even trading. Greece is the same story. The reason that the central bankers of Europe didn't understand the way that we understood what danger they were in is because we know about the jackals better than they do. And the shorts, right? The people who will make money coming in and short. George Soros did that to Britain. Are so aware of the technique and its power that it doesn't really matter. The truth, whatever that might be, doesn't really matter. Maybe Greece only needed 13 or 33 billion. Whatever. So what? That's unimportant. What's important is did you and I and 13 of our closest friends pile onto this thing and all short it? And if we did, it's going down. So that's what Europe was fighting. And that is so much more important than Forex, right? I mean, the actual trading of, the legitimate trading of currencies is unimportant compared to the pressure brought by shorts. And the great danger, which we saw in '97 with all the collapses of currency. Right. Remember that, one by one? It wasn't because those countries were getting sick day by day. It was because the jackals were going, next. And it's literally just a matter of picking one, and the next weakest one, and then going at that.
So,
So we have a problem in shorts is the short answer there. We have to fix that somehow.
regulation of the jackals or of that kind of trading is
Yeah.
more important than regulation of the banks or...
Yes. Well, it is one way to regulate the big problems that we've got right now in the markets. You hear Wall Street guys tell you this with a straight face, and I think they mean it. They go, shorts are a natural part of the natural order. There's a long and there's a short. It's that simple, you know. And I don't think that's how the world works. To me, the long is, oh, you like the company, you bought it. You buy the shares. Right. If you didn't buy the shares, that's the short. You know, it's not like, no, I bought these options against it, and then I called all my friends, and we called all our friends, then we called the press, we told them 3 lies about how bad the company is, and then the stock went down, right? That's not right. So whether you either eliminate shorts, which probably won't happen, or at least put uptick rules back and some serious restrictions on shorting, that's extremely damaging, destructive practice that in my mind has no real place in the economy.
The SEC has been looking at the uptick rule for at least a year now, right?
Don't push it. You know, right. It takes time to do these things.
I mean, what do you think realistically could happen in all this, or what would be the consequences of the different things that might happen? In regulation, and either globally regulation or, I mean, I know you have to condense a lot into a simple.
I can't believe that we have short memories as human beings. It's hard to believe that we're having a debate about whether to regulate. We're actually talking. After having destroyed our own and the world economy and come this darn close to the edge of all that we know and hold dear, and we're having a conversation about, well, I don't know, maybe we don't need any fixes. Straight-faced, right? So we do need fixes. And it's the banking industry spent $1 billion to pull off Glass-Steagall Act during the Clinton administration. I met the woman who led the effort. $1 billion in cash. They've spent easily that much fighting some things since then, and they're spending a lot of money right now against this issue. You cannot rely upon the lobbyists to come up with the right answer. And our biggest issue in America, and I think everyone knows this, is that the lobbyists are running the circus. Mm-hmm. So will we get regulatory assistance? You know, I don't know if Obama has the team to put it together, but we need it. We definitely need it. It's actually possible that it wouldn't get passed or that it wouldn't be tough enough and that we would go right through something 10 times worse than what we just went through. And we wouldn't have any more bullets. You know, how much extra debt load can we take on right now? Right. So I really hope that they bring back, they now call it the Volcker, what's the Volcker?
Remedy.
Yeah, good. You know, marketing is great. So it's not the Glass-Steagall Act, it's the Volcker idea. And it's the same idea exactly, and I hope they pass it, and I hope they put the uptick rule back in. That'll help.
What can we say about the prospects then for investments and for inflation? I mean, what do you...
Two different ideas. Mm-hmm. It occurred to me sometime, about a year ago, I was watching Goldman, and maybe it was longer than that, it was before the crash, and I realized these guys aren't like the rest of us, you know. They're doing something in that building that nobody else is doing. I don't know what it is. I'm not saying that it's all illegal, or even that, you know, we do know that a guy was caught in the airport apparently with Goldman source code that at least one person in public, in the press, said looked like Forerunner code. That story never got picked up by the press. I don't know whatever happened to that guy. That's interesting. But even if it weren't so, they are so good at what they do that the game they're playing and the game you and I might play in the market isn't the same game. You know, when they locate servers within so many feet of the trading servers because they need that extra microsecond, I don't play that game. So my servers are on an island, you know. So I just think that people ought to be very careful if they're in a situation where they're betting against or with Goldman, and that's true for a lot of investments. They'll see the stocks in this new market move in ways they couldn't possibly have anticipated.
Not unlike the super mercantilists, it's like this whole super class of sophisticated financial players that change the game.
It's not only is it kind of tragic, it's very advanced. You can't blame them because they're playing by the rules, I think, mostly. But the rules maybe have to change because if someone gets that good, if all they're doing is extracting money and they're not in the supply chain, then the whole idea of markets doesn't work. Now you have what I call vampire investing, where I'm just going to take some blood, but I'm not going to give you anything for it, right? And how much of that can we take? What if they extracted? We've learned that two guys can do global damage. So what if they extracted? I know that one estimate 2 years ago was $600 billion a year from the American economy for nothing. Well, what if I said it was 1.2 trillion? What if it was 5 trillion? At what point do we wake up? Or do we just lie there on the table with the thing in our veins and never wake up at all? So that kind of investing is destructive. It doesn't help anybody. It doesn't correct the market. It just takes. So if you read the latest Goldman, yesterday I think Goldman came out with their latest quarter.
Right. They're doing well.
35 days of over 100 million in profits. 78% of the profits are trading profits. Every day was better than the day before. That's never happened before. All trading.
And yet they're also walking this walk of shame at the same time. But
not really. Not inside that. Yeah.
And then, well, I linked this to inflation because investors are going to be sort of concerned about that separately. But talk to hyperinflation and to inflation in general.
The largest original problem going forward was going to be hyperinflation. All the central bankers know it. They still know it. But a funny thing happened on the way to the forum. The damage was so great from the last time around that whether it's permanent or 10 or 15 years, pretty clearly Ben Bernanke understands, and I think probably the Obama team understands what we're talking about right now. So instead of worrying about hyperinflation on Tuesday, or how to get in front of it now because it's going to happen a week from now, I think they all know that there's too much damage. So in a very strange way, the damage caused is assisting in some ways the return of the parts of the economy that can come back quickly. So this schism is actually represented there as well. So you've got big assists made available with low interest rates that couldn't have been done except knowing that the damage will prevent hyperinflation in the short term. In the long term, it's still a real threat. But that's a pretty long term now.
What is that? 5 years, 10 years, 3 years?
Probably 5 to 10. Not sooner than 5. And if you keep in mind that all this started, and there are very few people who get this, except people in this room, this stuff didn't start because of American banking practices. And it didn't start because of subprime loan practices in the United States. It did start because of a couple of things that were done on a global basis that doubled the global liquidity over a 5-year period. And if you saw that coming, and S&Sers knew about it back in March of 2007. If you saw that, it was like someone had poured gas. You're inside a warehouse and someone poured gasoline all over the floor of the whole warehouse, and there's a guy smoking at the far end, and it was like, don't smoke. You know something's going to happen. It's just a matter of when. And it did. But it could have been one of 50 things that went wrong. All the inflation that we saw, first in real estate prices, not just here, but in Spain, in France, in England, around the world.
Hong Kong.
So all this hot money, we went from 36 trillion to 72 trillion over 5 years. By the way, the only guys who seemed to get this were doing exactly the same thing that I was doing. They weren't watching the balance sheets, which were lies, right? The banking balance sheets today are lies. They weren't kind of watching the usual GDP numbers, which are made up. What they were watching were fund flows.
Right.
And the FT actually found these guys. There were 3 guys. They found them. They're all watching fund flows. Well, we better start watching fund flows. I mean, that's the big lesson here. So if you were watching fund flows and you wanted to worry about inflation, you were worried about, that's what you should watch.
So let's highlight that number again. It was 36 billion in...
Trillion.
36 trillion, pardon, in 2002-ish?
2, 3, yeah.
And then it was 2 trillion. Double that.
In 5 years.
Just before the
Yes,
meltdown.
that's right.
And what is it now? It's still...
I don't know. The worst part of this story is people don't measure this. It's very hard to measure, and no one's in charge of measuring it. So those numbers came out a year after the collapse. When I was trying to put this together, I didn't have those figures. I was seeing the money flowing in through the carry trade in Japan and through the price rises in petro markets. So, and if there were a third place, it was probably the stuff we're talking. It was like vampire investing. So there were some new sources of hot money, what I call hot money, that needed a home. And you could see these pieces that were coming in as kind of a trillion here, a trillion there, and you think, well, wow, that's actually spending money. So, you know, where's that going to get put? Is it going to go into bonds, stocks? Where's it going to go? A lot of it went into real estate.
And by hot money, you mean money seeking quick return.
Yes.
Funding lots of efforts to provide quick return.
Yes.
Many of which are producing goods and services that people don't really need.
Or that are bogus.
Or that are bogus in some way.
Yeah.
And creating a kind of bubble of bubbles.
Absolutely. That's right.
And did that bubble burst, or did we sort of prevent it from bursting in the short term?
Oh, no, it definitely
burst.
All of them, not just one. All those asset bubbles burst.
Okay.
Real estate, stock, you know, different countries, different markets, they all burst.
So, given all of these trends, none of which, if you looked at them separately, you would think, well, that's a good thing. Mm-hmm. Where do you look for hope? Where do you look for the promises, either in industries or in countries?
There is hope here. So one I've tried to lay out already, which is I think if the world learns how to protect IP, that's our only path forward. Whether you're making movies or whether you're making chips, that's got to happen. And so the sooner that happens, the better. The emergence of these new consumers in the world is really actually kind of exciting. And so there are large new markets technically available. There are large new markets in terms of headcount that are available. And there's every reason to be quite optimistic that if we got these basic things right about trading, there would be lots of growth available for everybody. China could grow, U.S. could grow, Japan could grow, India could grow. You know, I think it would be a very exciting story. So the trick isn't that we don't have the right materials at hand. The trick is whether we're smart enough to stop blathering about politics and focus in on the system and figure out what part is broken and how to fix that.
How does the environmental imperative play into the growth then? You know, we've heard a lot about, you know, if these people come into the middle class, we're also draining the capacity of the planet. And then we're also trying to boost economic growth and meet their needs at the same time.
Well, like Larry Smarr, I call myself a long-term optimist. And I don't see people as a threat. I don't think that this is a threat. I guess it's a threat if you do everything wrong. But I presume that we're going to learn about this stuff. It seems to me that the largest businesses available, as Vino would tell you, and as the Chinese would tell you, and I think a lot of Americans understand this, is in clean energy, alternative energy, green. This is great. You know, it's just what drives the new economies and new technologies. We need something. We need a big problem right now. Right. It's like, you know, the next war. We need a next war without the war. So here we go. It's obvious what to do. The requirements are clear. It couldn't be more important. Let's do it. Right? I wish we had a Churchill. You know, I wish we had a Roosevelt. I would love it if Mr. Obama would stand up and say, "I'm very sorry. I'm going to hurt your feelings now." And I recognize the importance of this problem, and I've got an answer. I've talked to Stephen Chu, and so we've got an answer. And here's what we're going to do. We are going to not build another coal-fired plant ever again. Step one, as of today. All plans are on ice. Forget it. Step two, for every existing coal plant, we're going to put in either a natural gas plant or we'll put in a nuclear plant. And that's a 5-year program. At the end of 5 years, we're turning off all the coal plants in America, period. That buys us 20 years. In the next 20 years, we're going to test all this other stuff we've got going, algae, whatever it is, solar. Everybody's got a shot at this, and we'll let the market figure it out. But we will invest, and we will help, and we will have tax policies that encourage this stuff to happen. And at the end of that 20 years, we're going to turn the switch again, and probably no more nukes. And guess what? By the way, Yucca is open for business. And if the people of Nevada don't like that, we're going to send the troops down there and open it forcefully, because this isn't an option-out kind of situation. That's the plan. And we're not voting on it. It's my plan, right? So that kind of leadership, I think, is what we need right now in many countries. And it would be really, I think people would love it. I think they would absolutely love it.
I do too. Mark, we've got about 30 seconds, and in that time, you've got an audience of technologists. What can you say to them about doing well while doing good in this environment?
Great way to make money. Yeah, you know, people, the generation that's coming up right now is so cool. I was at a meeting, and a guy from Harvard, Kennedy School of Business was there, David Yergin, and he said, the only way we can go wrong is to discourage these kids. If we discourage them, that'll wreck it. So they are set to go, they're smart, they're motivated, they understand the problem, they are engaged, couldn't be more perfect. And I think that's true. I think that we've done a pretty medium to poor job of recognizing their problems and dealing with them, but this generation is set. And our Thunderbird kids would be the first proof of that. So I'm totally encouraged about the idea that here's a baton, sorry about the mess, please do better. And I think they will.
I think that's a great note. Thank you very much.